Hello and welcome to Value Research Helpline. Wish you all a very happy new year. I'm Ruchira and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining us is Ashutosh Gupta, who heads the mutual fund research team at Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Today's first question has been sent in by Anant Garg, who wants an explanation on the three-bucket strategy for a retiree to get regular income from his retirement corpus, and he also wants to know which category of mutual funds should be used in each bucket.
The idea with the three-bucket system for retirement is really to apportion your retirement corpus across different time buckets, which are suitable for that time horizon and help you derive regular income. So for instance, the money that you need as regular income in say the next 1.5 year has to be invested in an absolutely safe way, so that your income need during this while is well taken care of, and returns is a secondary criteria. So products like liquid funds suit for this kind of a bucket. Then as we move slightly beyond, say up till the next 3 to 4 years, the idea is to generate steady growth even though the returns might be modest, but the idea is to not take any undue risks and largely invest in high quality debt products. Something like high quality short duration funds can fit the bill here. And then beyond that, for a slightly longer term horizon, the idea is to invest in a way that your investments are able to generate inflation beating returns for those long years of retirement. And for that, in this bucket, it is necessary to add a little bit of equity to your overall mix of investments. Now, taking all of this together, the way we recommend retirees to invest their retirement corpus is that they can allocate the income requirement for the next 1.5 years in one or two good liquid funds, and from there they can simply set up a systematic withdrawal plan to derive monthly income. Apart from that, they can look to allocate about a third of their total accumulation in a few good equity products, such as one or two good multi-cap funds, which over a long term should aim to generate inflation beating returns. And then the balance amount can be invested in a few high quality fixed income alternatives, such as high quality short duration funds. For this bucket, even some of the government sponsored schemes like the senior citizens savings scheme can be appropriate. So the idea is, once one sets up his retirement portfolio in this way, then one can rebalance these allocations periodically, say at the start of every year, to restore the equity allocation to 1/3 of the remaining allocation. And for the next 1 year's income requirement, that can be shifted to a liquid fund. And this way, this allocation can keep rolling on and one can keep deriving regular income year after year. Now, the important ingredient for this kind of a framework to work is that one should not go overboard and be too aggressive with his withdrawal plan, more so at the start of the retirement phase. So one should typically aim to withdraw not more than say 4 to 5% of one's accumulation in any year as retirement income. Otherwise, one would end up drawing down his or her accumulation at a very rapid pace and face the risk of outliving one's retirement savings. So that's broadly in a nutshell the framework of three bucket system.
Now, Vijay Anand says some multi-cap schemes have not yet become flexicap. Will this adversely affect their investors?
Well, as many investors would already know that recently SEBI has mandated multi-cap funds to invest at least 25% of their money each in large caps, mid caps, and small caps. Now, conventionally, if you look at multi-cap funds, they've largely been large cap heavy funds with smaller allocations to mid and small cap stocks. Now, this change would force them to significantly alter this current investment pattern and add a fair degree of mid caps and small caps to their portfolios. So investors who had invested in multi-cap funds for their large cap tilt may find, going forward these funds as unsuitable and more aggressive or more risky for their comfort zone. But having said that, I'll say that there is really no hurry to take a decision at the moment. As things stand now, about 10 to 12 multi-cap funds have already communicated their decision to switch over to the flexicap category so that they can continue to manage the funds the way they have been doing with a large cap tilted portfolio. And as we move on, there may be more funds which come out with similar communications, their decision to move to the flexicap category. So I'll say there is no need to take a decision in a hurry at the moment. Let things settle down, let more clarity emerge on what different multi-cap funds are planning to do with whether they continue to be in the multi-cap category or the flexi-cap category, and accordingly decide. The other thing is that if one does decide to move away from the multi-cap fund, then one should keep the exit loads and the tax applicability in mind. Typically, equity funds become load free after a holding period of 1 year. And also on the capital gain tax front, after a holding period of 1 year, one is eligible for the beneficial tax treatment that the long-term capital gains tax fetches. And there up to 1 lakh rupees, the long-term capital gains are also tax exempt. So one can make use of these provisions and stagger one's exit from a multi-cap fund so as to minimize or completely avoid load and tax implications. But one should, take a pause right now. Do not act in hurry and let more clarity emerge before taking a final decision.
All right, the next question has been sent in by Chandan Agarwal, and he asks, if his investment horizon is more than 10 years, can he still follow an asset allocation of 70s to 30, 17 equity and 13 debt, or does he need to have 100% equity? In case of 70-30, is it better to invest in aggressive hybrid funds, or should he create his own mix of equity and debt?
Well, to answer his first question first, by all means, he can go right ahead with the 70-30 equity to debt allocation if that gives him a sense of comfort, because the debt allocation here would cushion the downside when the equity markets are witnessing a significant fall. And if that cushion helps him stay the course and not exit the markets in panic, then by all means, a 70-30 allocation can be suitable even for long-term goals of 10-year or even more. So that's on his first question. Regarding the decision about whether to go for an aggressive hybrid fund or build this equity debt allocation with equity and debt fund separately, well, let me provide the pros and cons of both of these alternatives so that he can take a more informed decision for himself. Taking aggressive hybrid funds first, well, what goes in their favor is convenience and tax efficiency, because these funds are fairly convenient and a hands-off way to get this kind of an allocation. The rebalancing is put on autopilot, and an investor really does not need to do anything, periodically by himself. Also, all the rebalancing happens in a tax efficient way, because when a fund sells either debt or equity and reinvests that money in the other asset class, no capital gains tax liability emerges. So they are a fairly tax efficient vehicle in that sense. Now, the flip side of aggressive hybrid funds is that they tend to be relatively more expensive, because if you look at their expense ratios, they are closer to, or by and large similar to, 100% equity kind of funds, despite the fact that they invest about a fourth of their money in debt products. So from that perspective, they tend to be a slightly more expensive proposition. In comparison to that, if we look at the proposition of maintaining equity and debt allocations separately, then of course the first point that goes in their favor is that this kind of an allocation can be created with lesser to overall expense ratio for this portfolio, because the debt funds in this setup would have lower expense ratio. Also, for a conservative investor who would rather want to stick only to the large caps, can well choose an index fund for the equity side of this allocation, and in that case the expenses of his overall portfolio would drop down substantially. So that's one point that goes in their favor. The second is that you can choose the best of both worlds. You can go about cherry picking the most promising equity funds and the most promising debt funds and combine them into a portfolio. But on the flip side, for this kind of an allocation, an investor would need to be much more hands-on, because he'll have to take periodic rebalancing decisions at least once a year. And while doing this rebalancing, one would also need to keep in mind the load and the tax applicability in mind. and try and do the rebalancing in a more tax efficient and a load efficient way. So all those decisions call for a greater time and effort investment on part of the investor. So with these variables in mind, he can really take a call whether he wants to go ahead, whether he wants to favor convenience, or whether he would want a more cost effective solution, even though that might be a little more time consuming.
All right, Girish Vyas asks, are there any ETFs focused on IT and pharma sectors? If yes, are they suitable for a conservative investor?
Well, there are 2-3 ETFs which are focused on the IT sector. In fact, they've been very recent launches, but there are none at the moment which focus on the pharma sector. But in any case, they are absolutely not suitable for a conservative investor. If you look at sector funds, they are at the top rung of the risk spectrum amongst all equity categories, and they can subject their investors to very severe ups and downs over the holding period. In fact, talking about IT funds, a user can simply go to value research and go to the fund page of any tenured technology fund and look at what is the kind of worst returns in any year that this fund has given. This information is available on the fund pages on value research online. And if one looks at a tenured IT fund, one would notice that this drawdown in any year could be to the tune of 65 to 70%. That was the kind of negative returns that IT funds had delivered during the tech meltdown of year 2000. So the idea is that one needs to be prepared to see this kind of a drawdown and not panic. And that's when one should really consider sector funds. But otherwise, for most investors, they are avoidable.
Harendra Pratap Singh Raghuvanshi has sent in the next question, and he wants to know what will be the impact of SEBI's new mandate for multicap category on the multicap index funds. Will they also have to allocate minimum 25% each of their corpus to large, mid, and small cap stocks?
Well, no, there would be no impact on the index funds which are managed in a multi-cap style, which follow a broader market index like a BSE 500. They would not be subjected to the revised investment mandates for multi-cap category that SEBI has prescribed. In fact, as strictly going by the SEBI classification of funds, index funds are a separate category altogether, and they are not clubbed with multi-caps, and therefore there is no impact. But more broadly, I'd say for the users of value research online, that there are several other categories which we club under multi-cap as one set, which will not get impacted because of this rule. And these are categories of focused funds, the fund of funds, the index funds, as I've already mentioned, and certain solution oriented products like the retirement plans or the child care plans. Now we club all these funds together to facilitate better comparison, because for most of these products, the underlying universe from which they make stock selection is same, and they have otherwise pretty similar attributes, and they are largely meant for similar investment needs. So that's why we bunch them up together in our classification of multi-cap funds to facilitate comparison, and essentially they compete for the same share of an investor's wallet. But if we go strictly by the SEBI classification, then all of these are separate categories. And on these categories, the revised investment mandate of multi-cap funds will not apply.
Madhu wants to know if it's better to do an SIP at the beginning of the month than end of the month. Also, in case of sudden market swings, should investments be done more opportunistically by holding some money in liquid form?
Well, I'd say don't think too much about the date of your SIP investment. Over long periods of time, there could be a high degree of randomness in which date works out to be better for your monthly SIP. So I'll say stop worrying about the date. The very purpose of doing an SIP is that you take the right time to invest out of the equation and you don't worry about that. So don't be guided too much by that. Instead, be guided by your own cycle of monthly cash flows. So I'd suggest that pick a date for your SIP, which is soon after the date when your paycheck hits your bank account, so that you start investing automatically even before you start spending your monthly income. Now, coming to the second portion of your question about investing opportunistically, well, I'll say that that's avoidable because, as you rightly pointed out, the market moves happen all of a sudden. and it's very difficult to preempt them and benefit from them. If you stay out of the market on a handful of days when the market makes big moves in an year, then your returns can be substantially low. Just look at the graph that we'll try to pull up on your screens right now, and you would notice that if you were not in the market on the 5 best days in any calendar year, then your returns would be substantially lower than what you could have otherwise made by holding on to your investments through the entire year. So that again reinforces the futility of trying to time the market and invest opportunistically. That would simply add a lot of activity, that would consume a lot of effort on your part, but I believe that the gains would not be substantial, and you won't be rewarded sustainably for all that effort. So avoid doing that.
All right, now Mukund says, value research has helped him enormously in becoming a better informed investor. He wants to know at what frequency does value research review and update the stock recommendations and the best buy list on valueresearchstocks.com.
Well, as far as the best buy list is concerned, it is reviewed by our equity analysts on a weekly frequency, even though there may not be too many changes on a week-on-week basis. But essentially, the idea with best buy is that any changes that happen there, the analysts are guided more by the valuation related triggers and not so much by the underlying fundamental attributes of the companies. Now, as regards the broader list of recommendations, there is no set frequency or a time frame on which those stocks are reviewed. They are always under a constant monitoring and tracking of our analysts. And at any given point in time, if any events or developments happen which compel an analyst to change his opinion on a particular stock, then they come out with an updated guidance as and when such a development happens. So there is no specific predefined frequency to it. Now, coming to the new recommendations that we release, typically our team always maintains a list of stocks that they like and the stocks which are approved for recommendation, but an analyst would like to hold on and wait for the price to be in more of his or her comfort zone. And when that happens, the analyst would be happy to come out with the recommendation. So that's why you would see that there could be a certain stretches of time when we do not come out with any recommendation, and at the same time there could be some other periods of time when we come out with recommendations in quick succession.
S. Murali wants to know what will be a better investment, sovereign gold bonds or RBI floating rate bonds for the same period?
Well, both of them are very different because the underlying asset class is altogether different. So I'll say that they're not very strictly comparable, even though the tenure of these two investments is somewhat similar. It is not very far apart. One is an 8-year tenured scheme, and the other is of 7 years. Now, so what I'll rather suggest him is to be guided by the investment objective or the purpose why he's making an investment, and then decide accordingly. So I'll just explain the purposes for which both of these can be useful, and hopefully that helps him decide which one to go for. Now, talking about the sovereign gold bonds or the SGBs first, well, we don't look very favorably towards gold as an investment. At best, it can be viewed as a hedge against equity during market downturns. If you look at historically, gold has done well pretty consistently during times when the equity markets are down and have fallen sharply. So from that perspective, certain investors like to add a certain allocation of gold in their portfolio in a steady state as a store of value, or as a hedge against their equity investments. And for that perspective, for that kind of a need, I think sovereign gold bonds can be one of the preferred, in fact, one of the best investment alternatives to take exposure to gold. They yield 2.5% over and above the appreciation in the gold price, and the appreciation of gold price itself is tax free. So overall, it works out to be a good alternative if you want to take exposure to gold. Now, coming to the RBI floating rate bonds, I'd say that they are a good option for your long-term fixed income allocation. Currently, they are yielding a return of about 7.15%, even though it is subject to resetting every 6 months. But 7.15% currently, in the context of the low interest rate environment that we are in, is a fairly decent return to get. So and also they can be a suitable investment for those who are looking for a regular payout, because these bonds pay out the interest, the coupon, every 6 months. So from that perspective, it could be a viable option for a fixed income investor. Now, basis these, he can decide which one suits him.
Now, Varun Upadhyay plans to buy a house in 2 years. When Sensex was 45,500, he switched from equity to debt. So should he now reinvest his accumulation in the market, hoping that rally would continue, or should he remain in debt for the next 2 years?
Well, I'd say he could have staggered his exit from the market over a period of time, but I well understand the apprehensions given the way things unfolded and whatever happened during the year earlier. So now that he's out of the market, I would say that for another 2 years to go, I don't think equity would be a suitable asset class to get back to. It's an important goal that he's been saving for, and there is really no point taking any further risk with that money. So I'll suggest him to stick to a few high quality fixed income alternatives for the remaining time till the time he consumes this money. And my best wishes to him. I hope he's able to find a good house within his budget, which suits his requirements.
The next query has been sent in by Shankar, who finds that the yield to maturity of debt funds is much lower than the trailing returns over the last 1, 3, or 5 year period. So, if he invests now and waits for 3 years, will his returns be closer to the yield to maturity or the trailing returns?
Well, yes, the YTM and the trailing returns can be significantly different. Just to explain the difference, trailing returns is essentially a backward-looking measure which tells you about the actual returns a fund has generated in the last 1 year or 3 years or 5 years or whatever other time period. On the contrary, YTM is essentially a forward-looking metric which gives you an indication of the expected returns from a fund from here on, should the portfolio of the fund be held till maturity. Now, typically, YTM gives a relatively better indication of the expected returns of a fund in case of closed-end funds or fixed maturity plans, because over there, the idea is that once the portfolio is constructed after the fund is launched, the idea is to hold that portfolio till maturity. And in the interim, there are really no inflows or outflows that hit the fund. So until and unless there are any credit defaults that the fund has to face, the YTM at the time of launch could be a fairly good indicator of the actual expected returns from the fund. Now, in case of open-end fixed income funds, the YTM is not as good an indicator of the expected returns, because the fund witnesses inflows and outflows all the time, and the fresh money has to be deployed at the then prevailing yields. Also, the portfolio itself might be relatively more dynamically managed, and there could be bonds that make their way into the portfolio or out of the portfolio. So that's why the actual returns could be fairly different from what the YTM suggests at any given point of time. Now, typically, YTM can be much lower than the trailing returns during times of falling interest rates, as the kind of time that we've just been through. Now, if you look at what should be one's expectation from here on, I'd say that over the next 1 year, one should not expect the kind of returns that the trailing returns seem to suggest, because of falling interest rates, which help prop up the bond prices. The trailing returns of many bond funds seem to be pretty good, but that should not be a criteria for you to set your expectations for the next 1 year period, where I'd say your return expectations should be more closer to what the YTM figures suggest. Now, over a 3 year horizon, which he's asked for, really it's a slightly longer shot, and really difficult to predict what kind of returns one would get. But I'd say that it should fall somewhere in between what the trailing 1 year return suggests or what the YTM suggests. So while the returns may not be as good as what we see in the trailing 1 year returns, but hopefully they should not be as low as what the YTM suggests either.
Krish Mohan is investing in Franklin Templeton US feeder fund since the last 1 year, but he wants to know if it's safe to continue investing in Franklin Templeton mutual funds or should he stop?
Well, I'd say that Franklin US Opportunities Feeder Fund ranks among the better international equity funds, and he can continue to invest in that fund. I can understand the apprehensions given as things have unfolded at Franklin Templeton and the unwinding and the unfolding winding up episode that has hurt the interests of the investors. But having said that, I don't really see many concerns as such as regards this fund. Also, it is noteworthy that this is just a feeder fund and which redirects investors' money into the Franklin US Opportunities Fund, which is managed offshore. So in any case, the investment management of his money happens offshore and is not subjected to the kind of distractions that the management here might be grappling with at the moment. So by and large, I don't see much concerns over there.
All right, now V. Swaminathan asks, which is the best Nifty index fund?
Well, to start with, I'll say that there are two main criteria that one should consider while opting for an index fund. One is the expense ratio, because these days on expense ratio, index funds are fairly competitive. You can get plenty of options at an expense ratio of as low as 10 to 15 basis points for the direct plan. So there is really no point paying too much more than that. So one is that be conscious of the expense ratio that a fund is charging. And the second is the tracking error, which is basically a reflection of how well the fund is able to replicate the index which it is following. So it's a measure of the efficiency of the investment management of an index fund. And like expense ratio, the lower the tracking error, the better it is. Now, if you look at these two parameters, I'd say that index funds from fund houses like SBI, UTI, HDFC appear to be doing fairly good.
Yugender Janjirala says the returns of infrastructure funds have been very low in the last 3 years compared to other mutual funds. So what are the chances of getting better returns if he invests in them?
Well, I'd say that the fortunes of sector or thematic funds can fluctuate wildly, over the years. If you look at infrastructure funds, there was a time when they were firing really well. This was sometime before the subprime crisis happened, and at that time, you could see infrastructure funds which were delivering even 100% returns in an year. But last 3 years, if you look at, he's right that this theme hasn't really played or worked out as well. Even the best of the infrastructure funds has lagged the broader market by far. And that's really the point about sector funds or thematic funds, that they are easily avoidable for a vast majority of investors. At best, they are meant to play a small tactical, they're meant for a small tactical allocation in an investor's portfolio, and that too if you have certain specific convictions upon a particular sector and you think you can take a call to make a timely exit from that particular sector or that theme when you believe that that theme has played out and it's time to move on. But otherwise, I'd say that more broadly for majority of investors, they are avoidable.
All right, now today's last question has been sent in by Gaurav Pandey, who wants to know, when investing in international funds such as Motilal Oswal Nasdaq 100 ETF, is there any benefit from rupee depreciation?
Well, currency movements do impact the returns of international equity funds. So if the base currency of your international allocation appreciates, then that would add on to the gains that your underlying international investments make. Taking the example of Motilal Oswal Nasdaq 100 ETF. So if you look at the past 3 years, this fund has grown at a CAGR of about 30-31%. While if you look at the returns of the Nasdaq 100 index itself during the corresponding period, they've been about 26% per annum. So these additional returns that Motilal Oswal ETF has generated can be attributed to the magnitude by which rupee has depreciated against the US dollar during this while. But it is important to note that it cuts both ways. So in case the base currency of your international allocation depreciates during this while, then it will also eat away into the returns of your underlying international investments.
Well, that was today's last question. But before we end this episode of Helpline, Ashutosh, I would request you to give our viewers 3 quick pointers to help them invest better in 2021.
Sure. Well, I'll say that the investment pointers or any broad tips would really be no different than they should be for any other year, but I'll try to make them a little more contextual. So talking about equity investors, I'd say that be disciplined and stay the course. Because if we look at a year like 2020 in the rear view, it is very easy for one to believe that after the markets have had a rapid fall, a very sharp decline, it was very easy to think that a bounce back is inevitable and try and time the market to make some handsome gains in quick succession. As eventually it turned out, some investors would have had an early success in trying to do just that. But I'd say that such a strategy is not very sustainable. So don't falsely believe into the virtues of timing the market or investing heavily in an opportunistic way. So don't be guided by the way things unfolded in 2020. Stay the course and be disciplined with your investing. Now I'll move over to the fixed income side, where I'll suggest investors to not try too hard to hunt for yields. We are in an exceptionally low interest rate environment, and typically for investors who've been investing in fixed deposits, they are in for a disappointment when they go for a renewal of their fixed deposits and they say they see a sharp drop in the interest rates, and that is when they try to look for alternates which are generating better yields, and that is when there is a possibility that they can be duped into investing in dubious kind of schemes which promise unrealistically high returns. So I'll say resist that temptation and be suspicious about any schemes which are promising unrealistically high returns at this point in time. And finally, my last piece of suggestion would be to pay attention to your asset allocation, because after a year like 2020, which turned out to be a roller coaster of a ride, it is likely that asset allocation of investors can go for a whack. So it is about time that you look closely at your asset allocation and restore the balance if it has gone too much out of whack. With that, I wish a very happy new year to our viewers.
Thank you, Ashutosh, and thank you to all our viewers. You can go to VR Helpline on Value Research online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Here's wishing you and your family a very happy new year from everybody at Value Research. Bye for now.